let's talk about the financial tools in your wallet. See, most of us are just participants in this huge, complex economy. But what if you could become a real player? What if you could take full control of your financial future? That's what we're digging into right now. You know the drill. You see it everywhere. Every bank is shouting about it. Swipe this card and you get free flights, amazing hotel stays, cashback on everything you buy. I mean, it sounds incredible, right? Like you're getting free stuff just for spending the money you were already going to spend. But have you ever just stopped for a second and asked, wait a minute, if all this stuff is free for me, who's actually paying for it? Because here's the thing, no matter how many freebies you get, the system is designed to win. And understanding how that system works, well, that's the key to mastering your own money. So let's start with the most common thing in our wallets, the credit card. On the surface, it seems so simple, but its design is, let's just say it's deceptively powerful. It can be an amazing tool, but it can also be a really, really clever trap. Okay, let's break this down to the absolute basics. A debit card, that's your money. You swipe it, and boom, the cash comes directly out of your bank account. Simple. But a credit card is a whole different beast. When you swipe a credit card, you're not spending your money, you're borrowing money from a bank. It's a loan, but it's packaged to feel instant, frictionless, and super easy. And you know what? All that easy borrowing, it really adds up. As of 2025, people in the US are carrying over $1.2 trillion in credit card debt. That's not just a number, that's a mountain of borrowed money that fuels an absolutely massive industry. So how does that mountain get so big? It's all about something called the minimum payment trap. Let's say your bill comes and you owe $1,000, but right there on the statement, it gives you this tempting little option. Just pay $25. So you do. And hey, no late fee. But that remaining $975, it doesn't just sit there. It starts collecting interest, often at rates over 20%, and the whole cycle starts again next month. And that, right there, is how a small debt can spiral into a huge problem. But look, your personal debt is only one piece of the puzzle. Let's pull back the curtain a little bit and look at the hidden machine that's making money every single time a credit card gets used, whether you're in debt or not. Here's the secret. Every single time you swipe your card, the store, doesn't matter if it's your local coffee shop or a huge online retailer, has to pay a small fee to the credit card network. It's often called an interchange fee or a swipe fee. And this is not just some tiny cost of doing business. Just listen to this merchant. For so many small businesses, these swipe fees are their second highest expense. Think about that. It costs them more than their rent. And where do you think that cost goes? It gets baked into the prices of everything. So in a way, even people paying with cash are helping to pay for all those free credit card rewards. And this is where the real money is made. See, companies like Visa aren't making their billions from your interest payments. That money goes to the bank that issued the card. No, they make their money from these network fees. They own the pipes, the infrastructure, and because of that, their profit margins are just enormous. We're talking 30 to 40%, sometimes even higher. It's a gigantic business built on billions of tiny little transactions. Okay, so if the system is this complicated, how in the world do you navigate it? Well, it all boils down to one single number. A number that basically acts as your reputation in the financial world. And that number is your credit score. The best way to think about it is like a financial passport. It's a number between 300 and 850. And it tells lenders one simple thing. How trustworthy are you with borrowed money? And this number is a big deal. It doesn't just decide if you get a credit card, it can affect whether you can rent an apartment, what interest rate you get on a car loan, even how much you pay for insurance. It's huge. So how do they even come up with this number? It's actually not some big secret. Look at this. The two biggest pieces of the pie, making up 65% of your score, are super simple. First, your payment history. Do you pay your bills on time? And second, the amount you owe. How much of your available credit are you using? Honestly, if you can just get those two things right, you are well on your way to building a great financial reputation. All right, so we've talked a lot about playing defense, avoiding debt, managing your score. But now let's switch gears and talk about playing offense. How do you actually make your money grow for you? The biggest enemy of your savings is this silent, invisible force called inflation. Think of your savings like a bucket of water with a small leak in it. Every year, because prices for things go up, the actual buying power of your money goes down. That leak is, on average, around 5 to 6% a year. So any money that's just sitting in a checking account, it's actually losing value over time. To make it super simple, think about your morning coffee. Maybe last year it cost you $4. This year, it might be $4.20. It's the exact same cup of coffee, but your dollars just don't stretch as far. So to really build wealth, you can't just save. You have to make your money grow faster than that leak. And the number one way to outpace inflation is by investing. Now, there are a ton of options out there, but let's just look at 3 common types. You've got your low-risk options like fixed deposits, which are great for just protecting your money. Then you have things like mutual funds, basically baskets of different stocks. They have more risk, but they also have the potential for much higher returns, perfect for long-term growth. And then you've got high-risk, high-potential assets like crypto, which can be a small part of a diversified plan. So, with all these choices, where do you even begin? Well, the most important thing is something called diversification, or as the old saying goes, you don't want to put all your eggs in one basket. So here's just one example of what a portfolio could look like for someone under 25. The biggest slice, half of it, is in mutual funds for that long-term growth. Now, because a younger person has more time to ride out the market's ups and downs, they can take on a bit more risk, so maybe 20% goes into something with high growth potential, like crypto. The rest is balanced out in safer things like fixed deposits and gold. The key isn't to copy this exactly, but to create a mix that works for your own age and your own comfort with risk. And that really brings us to the most important point of all. Your money is always working, whether it's sitting in a bank account slowly losing value to inflation, or trapped in a debt cycle, making money for a bank, or invested in the market. It is never just sitting still. It is always working. So the only question you really have to answer is this: is it working for them, or is it working for you?